Hello and welcome to today's Women and Money webinar. My name is Vishnya Rajnovic. I'm a Senior Private Client Advisor at Lifestyle Financial Services and I'll be your presenter today. So let's start because we have a few things to cover today. The agenda for today's webinar will discuss why and how women are different when it comes to creating wealth, how we can plan for these differences. We will also discuss how to get into some good financial habits and the importance of seeking support along the way and selecting a good financial planner. Before we look into each of these areas outlined in agenda, could I ask you to answer the following question for me? What do you think is the percentage of Australian women running a business? Okay, some of you got the question right. So the answer is B, 34%. Quite an impressive fact. Why then the state of women's finances is not as impressive? This brings us to a question, why are women different? And how have we and our lifestyle changed over the years? What is the difference between the baby boomers generation and the generation X, Y, and Z? Well, let's just say it's a completely different landscape. As you can see, things were very different for our parents and grandparents' generation. Each generation faces different challenges. Baby boomer women in most cases were completely and financially dependent on their husbands. This is for the living expenses and also for the later in their life when they do retire. The generation X, Y, and Z, on the other hand, are more independent. We tend to marry later. We also have children later. We are more educated. We are more career focused. So our attitude to money is different because we are more independent. There's also a difference between men and women's income. You may have heard about the wage gap, which impacts on the wealth accumulated by super as well. There's a number of issues affecting women's super, such as having career breaks. Many women work in part-time capacity, whilst they care for their children or they care of their elderly parents. Not to mention that women work in a lower paid industries such as nursing and teaching, and we also live longer, which means that we need more for retirement. Back in 1909, the statutory life expectancy for a 65-year-old lady is only 78. Fast forward 100 years, and the life expectancy age has increased to age 87. That is an additional 9 years that you have to cater for. Let me explain what statutory life expectancy actually means. So if you are 65 years now, half of all the other 65-year-olds in Australia will still be alive at 87, but the other half wouldn't have made it. So for those lucky enough to reach their statutory life expectancy, you actually have to make your money last much longer than that. So with this in mind, let's talk about some habits on what we can do now to help you start saving. We are all busy these days looking after family with kids' sports, dance recitals, school drop-offs, doctor appointments, and if you have elderly parents to look after as well, well, that's something else you have to manage. I feel exhausted by just saying this, let alone doing it. Sometimes it is difficult to concentrate on anything else other than getting through the day and keep functioning as normal as possible. But putting yourself first every now and then is vital. If you take the time to think about what your own financial goals are, this can only put you in a good position to move forward. And the sooner you do it, the easier it will be. Take the time to work out where you are at now. What debts do you have? How much income do you earn? What do you spend your money on? Can I ask everyone a quick question here? Who has done a budget? Okay, some people have done the budget, which is really great. There are many apps and web pages that can help you with this. The website that I find very useful is a government website called Money Smart. It is a great place to start. And since you're there, have a look at some of the other tabs. It's quite a lot of really interesting information. Once you're ready to start saving and make some inquiries about the different types of the low-cost bank accounts and the likes, so you can put some money aside on a regular basis, that it isn't going to cost you the earth in terms of the bank fees. Once you know what your budget is, how much you're spending and what is left over, it is really much easier to make the decision to start saving and putting it away. Could I ask to answer the following question before we discuss the second of the 9 good habits? Thank you. The answer is 85%. This is quite an alarming fact. Well, let's see how we can improve this. Majority of my female clients initially said to me, Vishnya, I know I have to do something, but I don't even know where to start. My answer to them was, we can start now, and we did. I understand that it can really be scary to navigate through all the information out there about how to save. There's just so much of it, and where do you start? So this is where we come in to help you and improve your knowledge about the finances. Like today, take the advantage of educational sessions we provide. These sessions and other educational topics are usually announced via our newsletters, which we email through. If you are not getting them directly, please call us and we'll make sure that we have the right email addresses for you. We'll put our contact details up at the end of the presentation. You can also start reading your super statements. You don't need to know it intricately, but you should be aware of what you are invested in, how much growth assets are in the mix, what are the returns, how much is being paid into your account, what insurances do you have you made a beneficiary nomination? And if you don't understand it, you can call the super fund for explanation, or even better, you can call us. So as a tip, if you have, for example, 20 years to retirement, which is a long time, do you really need any defensive assets in your investment mix? Defensive assets, as you can see on our screen and the graph, are things like cash, term deposits, fixed interest. These assets are less volatile and provide lower return when compared to the growth assets such as property, Australian shares, international shares. So if you want your super to work as hard as possible for you, you could consider increasing the growth assets exposure. What your money is invested in will have a big impact on how much you have at the end. It is important that you have an understanding about investment risk and what that means. In a very simple terms, the investment risk is the chance that your investment may drop in value, doesn't keep pace with inflation, or won't be enough for you to draw a reasonable income in retirement. Risk isn't a bad thing. You just need to understand how it affects the returns. On our graph, on the left-hand side, you can see our defensive assets, which means if you invested in a cash, in term deposits, in the fixed interest, the volatility there is low and your return is also low. Whereas the growth assets, which are on the right-hand side, such as shares, domestic and international shares, and also property, you are exposed to a higher risk, but you are also rewarded by the higher potential long-term returns. With an increased possibility of a higher return, you must be able to accept the increased possibility of a loss. Let's look at the other practical tip that you could consider for your superannuation. Apart from your property, if you are lucky enough to get into the market, your super is likely to be your biggest asset. You could search for an account that you've forgotten about by logging onto MyGov website. Then bring it all together into one account so you don't lose it again and potentially pay duplicate fees. But be careful of the insurances though. You don't want to lose any of the insurances that you might actually need. Also make sure that you have your tax file number on your super accounts so you don't get charged the penalty tax of 32%, which is on top of the regular 15% super contribution tax that you're already paying on your regular contributions. Once you've done that, Have a think about whether you want to make additional contributions into super on top of what your employer is making for you. One method, for example, is salary sacrifice, where you will ask your employer to put an amount that you want into your super account rather than paying it into your bank account. This will mean that your take-home pay is lower, but it also means your retirement pot is getting bigger and working harder for you. The immediate result is that the tax savings between your marginal tax rate and the 15% contribution tax rate. Let's look at it from the practical point of view and let's look at some numbers. We have Marianne here. She is 35 and earning $55,000 a year. We have assumed that her salary increases each year with inflation at 2.5%, and her super fund earns a return of 7% per annum. Over 25 years, simply by contributing an additional 4%, which is about $42 per week, into her super balance has grown by $96,000. Imagine the growth if her salary goes up by more than 2.5%. And now imagine if she increased her salary sacrifice contributions by more than $42 per week. Now, to put the $42 per week in a perspective, that is cost of 2 coffees per day per week in Sydney. Also, you can invest outside of the super. And when you start to invest is really important too. The earlier you start, the easier it is, thanks to the power of compound interest. In simple terms, you are earning interest on top of interest. We have a different couple here for comparison. We have George and Sarah. They both start investing with $5,000 into managed fund, which earns 7% per annum, and they add $1,000 each year until they turn 65. Because Sarah has been attending our seminars and knows to start early, she starts investing when she's 21. And George starts 10 years later at age 31. By the time they're 65, Sarah's projected investment is worth about $173,000 more than George's. The point I'm trying to make here is to start today. This next tip is one of the most important to me, and that's getting insurance. This is the basis of your financial health. Show of hands, how many of you have insured your income with income protection insurance? Okay, this tells me that none of you have income protection, so there is definitely something to talk about. Your ability to earn an income is your most valuable asset. Without it, no amount of planning you do can get you into a better financial position. This is really important to me because of my youngest client, who I call Jane. She was just a normal young person enjoying her life, and when she was 24, she became totally and permanently disabled. She had little super because she had just started working, and she had never really thought about super because retirement was so far away. What saved her was her total and permanent disability insurance that she got as part of a corporate super account. She and her husband, who is now her full-time carer, relies solely on Centrelink benefits and her super with insurance payout to survive. This payout is probably going to be her only asset. So I can't stress enough that even if you are young, you need to think about insuring yourself for the worst case scenario because it can happen. Imagine yourself being Jane's position. Quite scary, right? I've got some stats for you that might be of interest to you. Just under 236,000 working age parents suffer a serious illness or injury every year. 17,000 are forced to stop working either permanently or for an extended period of time. Over 1 million working age parents with dependents will be impacted by that serious accident or illness. More than 1 in 5 families will be impacted by an insurable event in their working lives. These are scary numbers. So have a look at your super statement and see what you currently have. And the question you have to ask yourself, do I have enough? And if the answer is no, then you need to contact us and talk about it with us. Now, develop strategy. You build some wealth. It is important that your money sorry, I got a bit of an issue here. Okay, it is important that your money is passed down to intended person. An estimated 45% of Australians do not have a will. Having a will provides certainty and direction to your family. This is really important because having instructions for your loved ones at a time when they are grieving for you will help minimize the level of stress that they experience, making a stressful situation just that little bit more bearable. Another tip is to make sure you have beneficiary nomination on your super account. This will ensure that your super balance and also any insurance payout is paid to people you actually like and care for. Develop a strategy, seek support. Having a plan will give you direction so that you know what you are working towards. What is it that you're trying to achieve? Our tax and super systems are complex, so getting good advice to help you navigate through your finances can make a big difference with saving time and avoiding the expensive mistakes. We can offer information on a range of money matters, from personal budgeting and investing to planning for retirement and protecting yourself with appropriate insurance cover. We can also help work through your finances if you have received an inheritance, are recently divorced, or have just lost a partner. If, on the other hand, you are struggling with your money problems like making ends meet or your debts are spiraling out of control, a financial planner, which is a different thing, can help you to get back on your feet. Again, the Money Manager, the Money Smart website has some information that can lead you to the right directions. Seek a support and speak to a financial advisor at Lifestyle. We can help you to identify what is really important to you, which can be hard to articulate sometimes. Then we will develop a tailored plan for you and help you to put it into action. More importantly, we help you to avoid making those very expensive mistakes that can sometimes be impossible to fix. We will also review your plan because, as we know, life changes. Things in our life change and nothing's set in stone. So as your life changes, your plan needs to change too. There are still many challenges that exist for women. It is really important that you take control of your finances, understand what you have and what you can do to save for the future. We all heard of the saying, money won't buy happiness, which I think it's true, but it does give you choices and financial independence. I know that I want to have that choice.
We will have this recording of this webinar available on our website shortly. Check back in a few days for that. You can also see on our website recordings of all prior webinars that we've run over the last couple of years. All of these are available on our YouTube page, and there's a variety of other resources on our website. So head to www.yourlifestyle.com.au and you can get this webinar in a few days' time, as well as plenty of other content to help guide you. Or if you'd rather speak to someone, feel free to send us an email or call us on 1300 349 188, and we'd be happy to guide you or talk about whatever you have on your mind. Thanks very much. We'll hang around for one more minute to answer any more questions that may come through, and then the webinar will end. Thanks very much for attending today. Have a great afternoon.